Hello everyone. I'm Nikolai Zaitsev, came from Russia. I'm living in Amsterdam already for 20 years. Made PhD here as a nuclear physicist and then worked in the banks. Last year I had, I'm a consultant. I'm working with various banks, and last year I had a kind of a gap in between the contracts. And I decided already for a signature, just it was planned, decided to go into the Bitcoin kind of projects. Together with my friend, we developed a trading platform for ourselves, kind of really high frequency and etc. Just to understand how the Bitcoin market works, really not Bitcoin itself, but how does it work, I started to look on the market, tried to make few predictions. And for example, in the in November, this is kind of my chart, and I'm making all the notes and try to predict for myself where the market will go. And in the middle of the November, I have foreseen that it will be a huge jump. I didn't know where it will go. Here on the Bitcoin Wednesday, November it was, I met some of my old friends, colleagues. I shared with him my views, and he said me, yeah, use Deribit. Deribit is using options. And he said, why don't you buy volatility? Volatility is just a general term among the traders. I went to Deribit, and Deribit, yeah, it trades markets, options, and etc. And I thought, why not just try to predict it? Because in the if you have option prices, you can predict. You can have a general view on what market will be doing. So, why we are talking about price? BTC is just exchange against fiat. It can be against other cryptos. It can be against goods, and everywhere you negotiate about the price. No, I have to. Then what influences the price? We can say, for example, horoscope. Yeah, some people are using horoscope, moon, I don't know, phases, whatever, and then I look it on the Google, and then I found, okay, there are some people who are just making professionally this kind of predictions. Right? They put all these kind of things into this, and it's pretty amazing. Weather, yeah, weather can be. It's not so funny, because if it gets cold, then the price for the gas is really gets high. Humans, of course, humans. We trade, and when we trade, we negotiate about the price, whatever for the good, for the other currency or whatever. We fix the number, and we record it. So if we buy, we think about the price going up, or we want to consume the thing. If we sell, then we think that the price is going down, or we have spare amount, so we can sell it to somebody. And of course, reality is more complex, but trade, what is important, trade is always recorded. So if we make a trade, we can say Bitcoin is now 10,000. Of course, we can go, but it's very unlikely that somebody will trade with 10,000. Yeah, it will go into some balance, and then this price will be recorded, and that will be the how to say, substantiation of our agreement between us in the number. For example, just a little experiment. How many people believe that in 1 month's time, the Bitcoin price will be below 1,000? Can you just raise a hand? Okay, nobody. If it will be below 7,000? Almost everyone. If I do granularly, then there will be some function. Yeah, we will see some function. It will be something like that. So between 1,000 and 7,000, and that, in the statistical terms, we call it as a cumulative distribution function. So we can measure it by pollen, and we can see what will be the belief of people in this price. We can, if we differentiate this function as a just mathematical term, we will get some distribution. I just made it very simply, very simple kind of differentiation between the bins, and I get this bell type distribution. However, can we measure the same thing from prices? Because it's really tedious to do polling every time we want to know what the price is. Can we measure this from prices? Can we measure this kind of belief? Because before the price is recorded, everyone has beliefs, and the transaction occurs if your demand meets the supply or whatever, and our own beliefs when they cross, and then the price is recorded. Fortunately, yes. And of course, what I have to just warn you is what I made it a bit provocative. It is not really what I present here is not really prediction of something, but it is measurement of the beliefs of people. Yeah. So people put their beliefs that I can measure and extract and give you as a result. First, there are a few ways to measure the future beliefs. It can be spot price. So everything what is recorded in the book, what we observe on the market, we see dynamics. We can just measure correlation, autocorrelations. That's up follows down, down follows up. Cross correlations between different cross currencies. We can measure certain lags. So it is, for example, with after 5 minutes announcement, you will get a price rising. Some copulas, I don't know. It's kind of some complicated terms about the distributions. It is not easy because the price does not follow the really strict laws. We try to extract these laws in mathematical terms, but they're always changing, because every time you see how the market behaves, we as let's say having with some intellect, we try to find another opportunity. Yeah, and the market itself is always changing. The order book is a bit more interesting to study, but that's also really complicated, because that's order book is not only the fair intentions when you want to sell or buy, but it also something about false kind of seductive behavior. It's called also flash orders. They are very famous, and yeah, recently it was published, especially in relation to high frequency traders. That's highly multidimensional problem. It is being solved. People use it and yeah, work with that. For example, just as a picture, I can show you how looks a book of BitMEX. So that was, for example, 2 weeks ago when I made a first snapshot and preparing this presentation. The price goes like that. And it is supported with, not supported, but bracketed with orders put beneath. Then it jumps. Then there are orders which are put here. they limit, and this yellow orders, this is a huge one, and they limit the upside movement, and then as a result of that it goes down. So we can see it. That's the example of 2 days ago. For example, these orders are still existing, and today I have seen that the price was going to this level. Yeah, you can analyze it. You can. Now, there is a third way to measure it. It's option prices. These two methods you can measure in usual exchanges like Coinbase, BitMEX, as mentioned, Bitfinex, whatever. They are exchanging one. It's cross exchange. BTC against USD, BTC against LTC. And you can try to monitor option prices. What I'm using here is not, I didn't invent. There was a paper which have described this kind of measurements, and it was in 1978. Option prices at different strikes allow to measure beliefs. So this is what I try to do. There are currently 3 exchanges. It's a Deribit, it's Amsterdam-based. Quedex, I think it is Polish. And LedgerX is focusing on the big traders, investors with more than 100K assets, 100,000 assets. Deribit is most, let's say, liquid and most democratic in terms of publishing of the data, so I've used that. Downloaded and started to analyze. To show my results, I have to come back to the option definitions. What is a call, for example? I conclude with you the contract on the call. If I promise to you, I sell to you the contract. If I promise to you deliver the asset, in this case it's Bitcoin, if price for the Bitcoin will go above the strike. So at some point, at maturity, you will come to me. If the Bitcoin is above the strike, you will come to me and give me Bitcoin, and I give you the price for that under the contract. And that can be expressed in the formula. Here's a typo. It must be reversed. So that's that, but this is correct. Yeah. There are calls, there are puts, and this type of contracts at different maturities, they are marketed on the Deribit. Yeah. This is a physical delivery. It's called, these contracts are called physical, with physical delivery because everything is accounted in the BTC. So the number quoted is BTC versus USD, but everything is in BTC. And also the payouts are also in BTC. Therefore, you have this hyperbolic, let's say, you have the division term for this in these formulas, which is unusual. And then, if you look on the payouts of the contracts as a function of the underline at the moment of the maturity, then it will look like this. Usual contracts, they have straight lines at this point. But since we have a division, then it looks like hyperbola. So red one, blue one is, for example, this one, blue, is long call, short call. Here is long put, short put, and this is the futures. So it is combination of the two, basically. Yeah. Now, the analysis is very simple. I have made, let's say, there is a put-call parity. It means that if you have long call, short put, and you short also futures, then this number will be dependent on the K, on the strike. And that's what I show. Long call, short pull, I sell pull, I buy call. Then my portfolio value will look like exactly like futures. And using the same relationship, I can convert also put call prices into the puts. I can put it on the, let's say, in the table, apply some function, which I describe. Its function is very simple. It's it's called sigmoid, integrated sigmoid. The data fit very well the model, and after very easy and simple transformations of the initial formulas and application of the sigmoid, I can get the distribution of the Bitcoin price. For example, that was for the March, looking from the moment of mid of December. Yeah, in mid of December, I have collected the data, measured what will. No, it's not March, June. Sorry, and then I look at what market envisions for the June. Yeah, and for example, this is touches beyond the zero. That's of course not kind of default, but this is the level of the perception of the public with respect to the price to become zero. Yeah? So it is kind of, I don't know, 3% as far as I remember it was measured. Next, if I look across many maturities, so I measure, I don't know, there are in January, there are in February, there was, but now we have, of course, different maturities, because maturities, they come, these options disappear from the market. And then I have many different maturities, and I project them to the 5-minute horizon. And that's all the maturities are kind of converged into the 5-minute horizon, and they show how the distribution looks like. I've done it in Monday, just for this presentation. That was a kind of vision of the market, where the market can be in 5 minutes. And that you can see it's pretty wide. In 5 minutes it can move plus minus $10. If I now you can ask a question. If the market has vision about a future movement, and I can measure it, yeah, I can imply it. So this is what I did. It's called to imply probability distribution. Yeah. If I implied this probability distribution and I check against the future price movement, will these two coincide? And I have done it, because with historical data I can check everything what I have done in the past, and then I can check the data forward, one step forward, 5 minutes. And just to illustrate for you, I compare two distributions, the forward distribution, actual which price has moved, with option implied probability distribution, and they match perfectly well, except very few corners. They are not really visible here. These are due to jumps. That's really events when price does not follow this really nice kind of smooth distribution, but really moves one direction, as you have seen previously, and perhaps you know. So on the website we have put, what we are going to do is we will publish every day this kind of snap shots of the market behavior based on our model, proprietary model, on the website. We want to put also some pricing facility such that trader can come and price any product, yeah, with any strike and any maturity, not only those which are priced on the deribit, marketed on the deribit, but any type of products, option products. And perhaps it might be possible to do it also for any products you like. There are exotic stuff. This is another kind of parameters. That's what I already told, and yeah, this is it.
So time for questions. Are there any option traders here available? No?
Question.
You have a question?
Not option trader though. The precision of the estimation of the probability distributions, as I understand it, depends on the liquidity that is available. How, if at all, do you measure what liquidity is kind of big enough to have really estimations?
Not liquidity if you are talking about option interest, no?
Yeah, yeah.
Open interest, sorry. This is not taken into account, but the curve fitting goes between bid and ask.
Okay.
So let's say if I take for the fitting, I'm taking mid prices of the option price of the bid and ask. I fit it, and the residual, that residual is, let's say, times less than the bid ask,
Okay.
average bid ask. So I believe it is more or less
Liquid.
not liquid but precise.
Thanks.
Because using that, I can reprice again any option price. That's what I convince myself. But you are right. Option interest is a part of the prediction. That's the next step.
More questions?
Yes, I have a question as a follow-up to your example of the options, to buy or sell options. There's quite some zoom in the background. My question is, if you buy protection against a price drop in BTC to US dollars,
Yeah.
it means also that someone is selling you protection.
Yeah.
Typically, those parties can manage that risk by short selling. Like if it was a stock, they can short sell at the same moment a stock, so that they also benefit from price drop, so they can manage their risk. How would that work in the BTC USD example? Because you cannot, on the other side, your counterparty, as far as I know, cannot short sell. So how would the counterparty manage its risk?
Deribit has futures.
And who's taking then those risks?
Yeah, of course. Futures is also another market. You need only to have three markets: put, call, and futures. And if you no, it's even before. If you, what I want to say, if you buy this, if you sell this, then it will be exact combination of that. It's a combination. And if you buy this, sell this, and sell this, then it will be just again the point. It will be just money, cash.
Yeah, that's what I sent. But
you don't need. What I say is this is a derivative instrument.
Yeah.
This is derivative, and this is derivative. If you combine them all, then it will your position will be fixed.
Okay, then maybe a bit simple example. If you only buy protection against the price drop, so you
Okay.
buy a put
Okay.
option.
Yeah.
Someone is selling you a put option.
Yeah.
How can that party protect itself against that risk?
He will hedge it with delta. It's called technical term. He will hedge his delta using futures.
Okay.
But like options are not linear, so you also need gamma hedge.
Yes, but as I said, these three are combining perfectly well
At one
itself.
moment in a time.
This is a kind of put-call parity. It's called. Yeah, this relationship is called put-call parity. And what you're afraid of, he does not in the derivative. It doesn't work. Yeah, he has to deliver the BTC, but the exchange takes into account that you are able to deliver it. So you have to put your 10 BTC on the account in order to be able to sell the put to somebody. So the put will be by Deribit. Maybe this is what you're
Right,
asking.
so they
They
manage
will put a margin.
a
yeah.
margin account.
Yeah, they will
Okay.
create a margin account and they will take out of your account some amount of money.
Okay.
So you are not able to sell an infinite number of puts.
Okay. Yeah. Thanks.
And that will be, if market goes against you, it will be liquidated automatically at your expense. They take 30% of the price of the assets which you kind of at the bottom.
Okay, Nikolai, thank you for your traditional financial market approach with the Bitcoin market. Everyone have a look at also Nikolai's website and Deribit to see how options work in the new asset class Bitcoin, basically.